Hi there, I'm Khalstian, founder of Egg Capital, and welcome back to the channel. Today I'm going to give my 2 cents on stock buybacks. Are they a friend or foe to shareholders? But first, let's quickly break down what a stock buyback is for those of you new to the concept. A stock buyback or share repurchase happens when a company buys back its own shares from the market. This reduces the number of shares available and increases the ownership percentage of existing shareholders. Now let's start with the positive side of stock buybacks. There are actually several reasons why stock buybacks can be great for shareholders. First up, earnings per share or EPS. When a company buys back its shares, the number of outstanding shares decreases. This can make the company's earnings look better because the same profits are spread over fewer shares. Growth in earnings per share can make the stock attractive to investors, potentially driving up the stock price. Secondly, stock buybacks can lead to stock price appreciation. When companies repurchase shares, the reduced supply in the market can increase demand. If investors see buybacks as a signal that the company believes its stock is undervalued, it can lead to increased interest, which may drive the stock price higher. Another benefit is that buybacks are a way of returning capital to shareholders. Companies that have excess cash on hand may choose to buy back shares instead of paying out dividends. This can be an attractive option for investors who prefer seeing the stock price rise rather than receiving regular dividend payouts. It also spares remaining shareholders the tax liabilities created by dividend payments. We could use Apple as an example, which is generating insane amounts of free cash flow. Free cash flow is the cash generated by the company after accounting for capital expenditures, and it reflects the company's ability to fund its operations, investments, and shareholder returns like dividends or buybacks. Apple is using most of its free cash flow to buy back stock and has done so over a long period. Since 2015, Apple has reduced the total shares outstanding with 32% from 22.3 billion shares to 15.1 billion shares. Finally, stock buybacks can signal confidence from company leadership. If a company is buying back shares, it might indicate that they believe their stock is undervalued and they expect future growth. This can give shareholders confidence in the company's future prospects. However, not all stock buybacks are as rosy as they may seem. Let's take a look at some of the downsides and why stock buybacks might not always be in the best interest of shareholders. One of the biggest criticisms of stock buybacks is that they often represent a short-term focus. Instead of using excess cash in innovation, research, or growth opportunities, companies might just be inflating their stock prices temporarily. This can be detrimental in the long run if it means neglecting important areas that could drive long-term shareholder value. Another downside is that stock buybacks can sometimes be used to mask poor performance. If a company's earnings aren't growing as expected, it might resort to buybacks to boost the appearance of its financials. This can create an illusion of success, when in reality the company might be struggling with other issues. I would like to use Adobe as an example for this. Adobe's revenues have been growing significantly, with 67% from 2020 to 2024, whilst net income has basically been flat since 2020, which is worrying as it looks like they can't scale without growing profits. But when we look at their earnings per share, the picture becomes rosier as there appears to be more growth over the same period. Earnings per share have risen with 14% compared to 5.6% for net income from 2020 to 2024. However, in truth, no additional value has been created because if Adobe would have paid out the stock buybacks in the form of dividends, the earnings per share growth would have been the same as net income, or even worse, as Adobe is paying stock options to employees, which increase the amount of shares outstanding. Paying out dividends does not increase earnings per share, as the amount of shares outstanding remains the same. Many companies also take on debt to fund stock buybacks. If a company borrows money to repurchase shares, they're increasing their liabilities. This could be a risky move if the market doesn't respond positively, or if the company faces financial troubles later on. Adobe is unfortunately also a good example of this, as you can see in my recent analysis of Adobe's stock. Adobe generated $7.9 billion in free cash flow in 2024. However, Adobe's $7.9 billion free cash flow is not sufficient to buy back $10.2 billion in stock. So how were they able to fund the stock buybacks? The answer lies in their total debt increase of $2 billion, which they have used as funding for the stock buyback. Increases in earnings per share and return on equity is often linked with executive compensation, so there could be a conflict of interest here. Lastly, stock buybacks could be seen as a substitute for dividends. If you're someone who values dividend payments for steady income, stock buybacks might not be the best choice. You could potentially be missing out on the steady stream of income that dividends provide. Another disadvantage is that the company you invest in is deciding how they spend what could be your dividend. In the end, it is a capital allocation question. And as an investor, it is completely reasonable to prefer receiving a dividend and invest it in a company that might be more undervalued. So after weighing the pros and cons, are stock buybacks a friend or foe to shareholders? Well, it really depends on the situation. Stock buybacks can be a great tool for boosting shareholder value when done responsibly, especially when a company is undervalued or has excess cash. They can signal confidence, increase earnings per share, and even lead to stock price growth. But if a company is using buybacks as a quick fix to mask problems, or if it's borrowing heavily to fund them, it can be a foe in the long run. Capital allocation decisions are one of the most important decisions made by management of companies on behalf of shareholders. I believe stock buybacks only create value if the shares are repurchased when they are trading below intrinsic value, and there is no better use of cash which would generate a higher return. As investors, it's important to assess why a company is engaging in stock buybacks and how it impacts the business long term. It's not about whether buybacks are good or bad universally. It's about understanding the context and how it fits into the company's overall strategy. Thanks for watching. If you found this video helpful, please don't forget to hit that like button and subscribe for more investing insights. And leave a comment below. What's your take on stock buybacks? A friend or foe? I'd love to hear your thoughts. Thank you for watching and see you next time.